My name is Kishore, and I'm an equity strategist at ADCB Asset Management. I will be your moderator this morning, but I would like to wait a couple of more minutes so that we let more people join this call. Thank you. I appreciate your patience. Right. Let's get started. A very good morning, everyone. Once again, to those of you who saw me earlier and to those who've joined us, welcome aboard. I apologize for this delay, but this was just done to facilitate more people to join this call. So once again, a very good morning, everyone. On behalf of ADCB, it's my absolute pleasure to be hosting you all this morning on this webinar titled The US Elections and What It Means for Global Asset Markets. My name is Kishore Muktinutalpati. I am an equity strategist with ADCB Asset Management Limited, and I will be the moderator for this session today. On today's webinar, we would be discussing the implications of US elections for global financial markets. Of course, there is more to be known in terms of the outcome of the US elections, but we said to ourselves, what we know should not be curtailed because we don't know something. So this morning, we want to share with you some of our thoughts regarding what we learned so far and what that means for global financial markets. But before I introduce to you our primary speaker for the day, I would like to quickly make a few housekeeping announcements. Firstly, this webinar is exclusive for clients of ADCB and not for anyone from the media. We are bringing this webinar to you from our ADCB offices and wanted to let you know that we're doing that responsibly by following all necessary precautions relating to the COVID-19 situation. This webinar is being recorded, and the recording will be made available to you in a few days' time. In terms of the structure of this event, we expect this to last about 60 minutes with 40 minutes of a discussion between our primary speaker for the day and myself, and the rest will be dedicated to answering questions from the audience, that's you. In case you would like to ask a question, please feel free to submit it in the Q&A box that you can find on the right-hand side of your screen. We would like to answer as many questions as possible, but in case we're not able to answer all of them live on this call, we will make sure that we revert to you as soon as possible. You can also mark your question anonymous if you'd like to. To make this session interactive, we would like to poll you to get your opinion regarding a couple of things. We would greatly appreciate your participation in these polls. Whenever the polls are made active, I will let you know, and you can then find them on the panel on your right-hand side again, exactly the place where you also find your Q&A box. With that, let me introduce to you our speaker of the day, Dr. Luciano Janelli, Head of Investment Strategy at ADCB Asset Management. A quick bio about Luciano. Luciano joined ADCB in 2014, and he heads up the investment strategy function within our asset management division, and is responsible for formulating the ADCB House View, which is the foundation for our strategic and tactical asset allocation calls. Luciano is also an adjunct professor of practice at NYU Abu Dhabi. He's also a regular guest on Bloomberg Television. Luciano started his career as an economist at the World Bank in the early 1990s, and he has held various senior research and asset management positions at UBS Group, Julius Baer, and also Swissquote Bank. Luciano, in terms of his education, holds a PhD in economics from Columbia University, and he's also a CFA charter holder. So Luciano, welcome aboard.
Thank you, Kishore. It's really a pleasure to be here. We are all yearning for some human contact since March, since the pandemic, since the lockdown, and this is a great opportunity, even if it is virtual instead of real, to do this with our clients. And to talk with our clients about what is going on, because it's sort of awkward. It's a year in which so many things are happening, and we are living in our protected environments. We should be grateful for that, but that should not prevent us from coming out and reaching out to our clients. And I think this is a great opportunity. So before we start, let me just quickly take this opportunity to introduce you a little bit better to the audience. So Kishore is our equity strategist. He is the person who is key in helping me understanding, the equity markets really better from a bottom-up level. Since I'm a macroeconomist, I look at the top-down macro aspects, and Kishore knows all the sectors, the equity sectors, very well. He has been with international investment banks for more than 12 years. I have been very lucky to have him with me, had with me over the last 2 years. And in particular, he was key in making sure that we took a constructive view on the equity market, and in particular on the so-called new economy stocks in March, when we were suffering, unprecedented historical corrections in terms of time. We had never had such a huge corrections this year. In a bit more than 20 days, we had some corrections in terms of 30% drawdown, and Kishore was key in keeping in our heads cool and in advising our clients wisely. So I'm very happy to have him here as my sparring partner to challenge me and to get this discussion going on the new shock. First we had a very heavy shock, the COVID shock, and this shock seems to be not such a big shock, the election shock. So I'm very happy to kick off on this discussion now.
Right. Thanks a lot, Luciano. Thanks for those kind words. Let's begin the conversation, and let me ask you a blanket question. What is your initial reaction to the election results so far?
So, the way we have always viewed this election is actually as something that should be positive. Elections are a moment of resolution of uncertainty, right? And elections in the US have never really been a problem. And this year, there was this serious concern about the election becoming a contested election, and in the limit, morphing into a constitutional crisis. And that, of course, that thing in the background of the mind of the market participators is something non-indifferent. And actually what has happened right now, seems to me, is that we had a little taste of that. It seemed to happen for a moment when Mr. Trump, late in the night in Washington, the president made those remarks about fraud because of continuing count of the votes. And we saw there the dollar strengthening for a moment, the yields coming down, the treasury yields coming down for a moment, essentially the markets buying into the safe assets. But I think that the markets saw through that. And so I would say that we actually are sort of getting into the idea that this will not be a contested election. We don't know yet for sure, but the state that could be contested, where it really could drag on, is Pennsylvania. And there is a chance that today Pennsylvania becomes irrelevant if Mr. Biden wins the states of Nevada, Arizona, in addition to Michigan and Wisconsin, which he has already won. So this has been pushed aside. Another element, which I consider resolution of uncertainty, something that seems to be positive, is in fact this likelihood that we are not going to have too much fiscal stimulus because the Senate will remain in Republican hands. Now, this has its pros and its cons in terms of what you want to invest in. But, if there is not going to be a $4 trillion package in new energy and other fiscal programs that the Democrats were so keen on, this kind of massive spending, that actually makes corporations more comfortable with the status quo. In the end, big CEOs of the big companies will be more likely to just keep on doing what they're doing and stick to their investment plans because they are not expecting major changes. So gridlock, or if you want to put it positively, checks and balances is not such a negative thing. So all in all, I view these elections as removing uncertainty, and I see them as something relatively positive for financial markets.
Great, Luciano. In fact, removing uncertainty is always good for financial markets. At ECB Asset Management, we always think about the outcomes in terms of scenarios. Whilst we don't know officially yet who is the next president of the United States of America, we always think about the potential outcomes and base that scenarios to think about our asset allocation. So if I may, based on different scenarios, how do you think this domestic policy, the monetary side, fiscal, and also let me put the regulatory thing there, shape in the next years in the US under various scenarios? And what do you think are the implications of those for specific assets if there is any change in policy, how would that really impact that?
Well, I think that we are likely going to keep very expansionary monetary policy. I think that we are not going to have the massive fiscal stimulus plans that the Democrats had, unless it's still not a given conclusion, because we are talking, as you mentioned at the beginning, still with some things not settled. No? So perhaps let me then take a step back. It could still be that Mr. Trump fetches the presidency. If he wins Pennsylvania, and that would perhaps take a lot of time to ascertain, but if he wins Pennsylvania plus one other state of the states that are still outstanding, then he still has a chance to win the presidency. As far as the Senate is concerned, it could still be that the Senate turns Democratic. This is not so likely. I would like to stress that paradoxically, from a viewpoint of fiscal and regulatory policy, given that monetary policy will remain extremely expansionary, paradoxically, the Senate is more important than whether Mr. Biden or Mr. Trump wins the presidency. And I think this is sort of the beauty behind all the noise by the media, And we have been talking so much about a contested election, and the election result is not clear yet, but we are already seeing that one way or another, it will not matter, right? And we have been talking so much about Mr. Biden and Mr. Trump, and we are seeing that one way or another, as far as fiscal policies and also regulatory policy, it's much more important what happens in the Senate, given that a Democratic Senate, of course, will change things dramatically in terms of fiscal policy and in terms of regulatory policy. So let me say this. If Mr. Trump manages to keep the office of the presidency and the Senate stays in Republican hands, then we are really in the status quo, right? And I would see the dollar really remaining much stronger. And I would also see much more global uncertainty and therefore continuing downward pressure on US yields. However, since this is not so likely, I think that with Mr. Biden staying in, winning the presidency, my guess is that we will have, in the end, some compromise on fiscal stimulus. It will take longer. It will be not more than 1 trillion. It will not be the 4 trillion that the Democrats would have liked to enact. And I think that in the end will be not so favorable for cyclical stocks, not so favorable for international stocks, but more favorable for US stocks, new economy stocks, the kind of stocks that benefit from lower yields, because I think that yields will remain significantly lower as long as the Senate remains Republican.
Right. Thanks, Luciano. And let's extend that conversation. And from the domestic policy, let's move to the international policy. Whether you think about the trade, the bilateral relation that U.S. has with several major economies, or even the multilateral efforts that U.S. always championed in, and of course, it has huge implications for the international institutions. How does that change now under various scenarios? And how does it? How should we? Please go ahead.
Yeah, I think this is a very important question. As far as the policies are concerned, whilst the fiscal and in the limit the regulatory policies are domain of the Congress and therefore the Senate becomes key. In trade and foreign policy, the US president is relatively unconstrained. And the way the US impacts the rest of the world is, of course, considerable because it's the largest economy in the world. So I would say that given that we are likely going to have not such strong fiscal policy, we already have less potential for dollar weakening than we would have had if we would have had more massive fiscal policy. What is likely going to happen if Mr. Biden wins the presidency is that we are going to get anyway some pressure of dollar strength, a little bit more of dollar weakening. If, on the other hand, Mr. Trump wins the election, then it's much more likely that we are going to have dollar strength because Mr. Trump is probably going to insist on weaponizing the US dollar as an instrument of foreign policy. He is going to remain sanction regimes. He is going to put pressure on China. Now, it's obvious that Mr. Biden is, as far as China is concerned, also going to keep a relatively anti-Chinese stance. But given that he's going to do that more in a multilateral framework, I would think that that is going to keep the dollar sort of from strengthening too much. He is not going to use that much sanction regimes. He is going to try to use his allies to put a cordon, so to say, around China. And I think he can benefit actually from what Mr. Trump has been doing, because Mr. Trump has already been creating indirectly actually quite some strong military coordination between, say, India, Australia, and the US against China. And so he can benefit from that by looping in the Europeans. But I think that there will be less talks about trade. There will be less talks about sanctions. So actually, that means that the dollar can be, a bit, can be prevented from appreciated strongly. And I think that that is good for international stocks and emerging market stocks.
Right. Quite a lot to unpack there, Luciano. In fact, we're still working with several different scenarios, and there are just several moving parts. At this stage, I would like to remind our audience, in case you'd like to ask a question, please feel free to submit that in the Q&A box that you can find on the right-hand side of your screen. We would like to answer as many of your questions as possible, but in case we're not able to do that, we will probably get back to you as soon as we can. So please do submit your questions in the question answer box, which is on the right-hand side panel on your screen. And again, before I turn to Luciano for next question, I would like to get the opinion of our audience regarding where they think the oil prices are headed. For this, we will activate our poll number 1. You can find all active polls on the panel on your right-hand side, again, at the place where you can also find your Q&A box. So the active poll reads, do you think that over the next 12 months, the oil price will be able to stage a meaningful recovery from its current lows? The answer is simply yes or no, just to get a quick pulse of what our audience feel about this oil price outlook. Let's give it a few seconds so that people can answer this. And Luciano, what do you think our audience will believe?
So I think this is very difficult to answer this question because perhaps we live in the region where we have the biggest bias in terms of an opinion. We don't want the oil price to fall too much. I would say also that we are all realistic enough that, you know, that a stable oil price is perhaps the best thing that we could have. To be honest, I am unable to guess the view of the market participants, but I would suspect that, you know, it would make sense to expect the oil price to sort of recover a little bit. It's really at, you know, so at the minimum, I would expect the participants to think that the oil price has some upside potential. Now, the question that we have addressed to the audience is if it will meaningfully go up. So that is the question. I think that most people would think it could go up. Meaningfully, I don't know. Do we have the answers here?
Yeah, let me just now break this suspense. It's a whopping 72% believing that the oil price will be significantly higher from the current levels, and just 28% saying they don't believe that.
Okay, that's good.
Now, Luciano, I just wanted to ask you as to how do you look at oil prices? Now we have a scenario where if Mr. Biden takes over the White House, he's been very vocal about being very hawkish on the traditional conventional energy, and his preference for clean energy has been very strong. He's indicated that in several instances. So in that scenario, how do you think oil prices will fare, and what are the dynamics that investors need to look at?
Okay, I find that a very interesting question because my immediate answer is that the US president is probably not so important because Mr. Obama really didn't like oil, and oil had the most beautiful run during his presidency. And in spite of Mr. Trump's all best efforts to favor oil, oil came down during his presidency, right? So it seems to me really that oil is something so big and so huge that even the US president cannot really impact the oil price, right? And what I would say is this. I saw a very interesting presentation recently by someone who is a real oil expert, and I'm not a real oil expert. And he mentioned that, you know, the oil intensity of global GDP has been coming down in a very regular way over the last 40 to 50 years, and that then determines this idea about some point in time over the next 5 to 10 years we're reaching peak demand. And he was hypothesizing actually something very radical. He was saying perhaps because of the COVID crisis and because of this permanent reduction in demand, we may be, you know, very close to peak oil demand. He was actually saying perhaps we had peak oil demand somewhere in December of 2019, right? Because you can see it, even in the US, we have such an increase in the number of people not anymore participating in the labor force. We have this economy transforming in a different mode. And even if we had a 30% pickup in GDP, we also had a 30% drawdown in GDP in Q2. Now, you know very well that if you go from 1,500 to 1,000, that's 30% down, and then you go 30% up, you go to 1,300, you are still something like 15% below, right? So there is this idea that we may be much closer because of the transformation and the hysteresis, the incapacity of the economy to recover, that we are much closer globally because of what's happening in particular in Europe and in the US, we are closer to peak oil demand. But that may be true, but there is also something like supply. So to now go to the majority of the participants who think that it will rise significantly. We are having now such a divestment from oil. And if you see how important the shale industry has been in pushing up oil supply over the last 10 years, no? And at some point in time, the US being, with 15 million barrels a day, really the champion in oil production, beating Saudi, beating Russia. It could be that we will have, when we normalize, when we get this vaccine, we don't know how huge we will normalize, but we will normalize to a large extent, even if we don't go back to normal. And then suddenly, with the shale industry being out of the picture, it's not going to be Libya with its new barrels to depress the price. We could have really sort of a supply constraint because of too little investments that has been going on now already since 2014, that we could have still a significant pickup of the price, say closer to $50 to $60 a barrel. So to conclude, I think that in terms of demand, it's true, it's going to remain depressed, but over a 1 to 2 year horizon, there could be also such a reduction in supply because of divestments, for lack of investments, that there will be an upshot in the price. And I think that that is actually quite reasonable to expect, that the oil price will recover to something in the region of $50 to $60 a barrel.
Right, Luciano. I think that is an insightful discussion on oil prices and the behavior, which is very important for the region. Now, one more time, I would like to go back to our audience to get their opinion regarding what they think equity returns over the next 12 months will be. For this, we will activate our poll number 2. And the poll reads, do you think that over the next 12 months, global equity markets will stage positive or negative returns? You can either vote for positive or negative, just a directional call. We'll give it again another 20 seconds and see how what our audience say. Development directional call on equities, either positive or negative, and that was the sort of poll question. In the meantime, I do acknowledge all the questions coming in. We will make sure that we are addressing all of them. So now let's quickly see what the results are. This is more balanced, Luciano. It's interesting. So 55%. Oh, that's falling now. It's 52%, which feels that equity returns will give a positive return over the next 12 months, and 48, therefore, rest believes it's negative. What is your take on this, Luciano? What do you think equity markets will do over the next 12 months?
Yeah. Well, my personal view is that we are not going to have a significant cyclical economic pickup. I don't see, in particular the US, which is for me the most important economy, going massively overboard in terms of fiscal policy. And therefore, I think that the cycle will be stable, and I think that that will be still good for earnings, because earnings have fallen down significantly. And because earnings will go up and interest rates will remain relatively low, I see a good potential for equity. And I also don't see any alternatives to equity because interest rates are low, and other so-called alternative assets have like gold have done already a lot. So I see actually a situation of economic stabilization, of sluggish growth, and I think that that is good for equities, for in particular high quality, big capitalizations. So I still see upside potential for equities, and I say that with a significant degree of conviction. But I do think that within equity markets, we should discriminate. And actually, perhaps therefore, since you are the equity expert and you are the one who makes these discriminations for us, I can turn the table around and ask you a question. And it seems to me that if really there will be no blue wave, and that seems increasingly likely, that cyclical assets and international stocks are going to do not so good as US stocks, sort of high quality new economy stocks. But it's not exactly like that, because there are still processes of normalization. We are coming out of the COVID-19 situation. Let's throw this election beyond us. We think it's gradually becoming less important. So perhaps you can sort of give some insights on that, particularly also within the international. I mean, blue wave would have been fantastic for international, right? Because it would have been massive fiscal spending, dollar down, good for emerging markets in particular. But it doesn't mean that international stocks are useless, no, or not good, that we cannot find some bright spots there. Perhaps you can sort of say something about that.
Right. So, I mean, in terms of the US election and its implications for equity markets, I'm quite mindful of the concentration that the index benchmark indices have onto the US. So, for instance, the MSCI All Country World Index has about 63%. A solid number of U.S. companies in as a share of the total market capitalization. Therefore, it's important when I think about the equity outlook, I think about U.S. equities too, and therefore, this U.S. election outcome sort of becomes slightly important in the sense that there was this consideration that if there is a blue wave indeed, then the corporate taxes and the individual, say the capital gains taxes go up, which impacts equity investors. Now, given what the market reaction was over the last day or two, after the results started trickling down into the markets, it makes me believe that some of these blue wave trades have sort of unwound in the sense that there was a shift back into the long-term growth stories like the NASDAQ 100, which has been our favorite index for a while now. That index rose 4% last night, which perhaps could be a knee-jerk reaction. But I think there's a narrative developing in terms of how markets see the outcome of the U.S. elections and what it means to what it means for individual sectors. And we keep writing these reports, and one of the reports recently we argued that despite who takes the White House, the equities will remain sustained over the next 12 months. That is after cautioning a bit of uncertainty in the near term, and which was tied to this level of contested election, if I may call it contested in its sense. And then we showed that both during the Republican as well as Democratic presidencies, equities tend to do well. But what is interesting is that the composition of the returns vary between these two presidencies. Under the Democratic side, you tend to get more earnings growth and less of a multiple expansion, which is the price that you pay for one unit of earnings that comes down, but you get more earnings. And on the Republican front, the earnings growth is not strong, but the valuations tend to re-rate because Republicans prefer not intervening with what happens on the corporate side. And if I think about the situation that we are in with the earnings being very depressed over the last 1 year, probably a Democratic presidency will give that tailwind, that much needed tailwind for equity markets in terms of the earnings growth materializing and so on. However, I would like to touch on two two sectors specifically very quickly. One is technology. There is a lot of discussion about this regulation coming through, and the US regulators trying to curtail the technology sector. If I look at this, I tend to sort of also remind the situation with infrastructure, where there is a consensus between both Republicans and Democrats, which is bipartisan, of course, that they need to do something about infrastructure, but we've not seen anything materialize over the last a decade or so, more than that, in fact. And I think the same situation also applies with the technology sector. There are people on both sides of the aisle wanting to curtail the technology, but they don't really know what to do. There are some extreme proposals from the extreme left, but will that get a buy-in from the broader Congress is something that I'm doubtful about. And then the discussion is about whether we are in a real dot-com bubble when it comes to the technology performance. And we've written very explicitly about this, that we're not in a dot-com bubble, because the technology sector today is a very different thing than what it was in the run-up to the dot-com bubble of the late 1990s and into 2000. And however, we've been advising on moving away from moving away from the US technology into also Asian tech. In fact, that sector has done relatively well too. However, in the near term, when there is a vaccine found, some of these stay-at-home trades will sort of unwind, and that could create a bit of an opportunity for investors to position back into the sector, but that, I think, will not be very material. The second sector I want to quickly touch upon is financials, where we have an underweight. We've been running an underweight for a while now. The flat yield curves, now given that a blue wave is sort of getting priced out of the market, the yield curve is supposed to sort of expected to flatten over a period of time, which means that financial sector will struggle with its profitability. Therefore, the dividends and the share buybacks get stalled. And also, there is a potential for the new Consumer Financial Protection Bureau regulation coming, and that could impact the financial sector broadly. So those are the two broad considerations that I wanted to make, Luciano. And if it's okay, we will now go to the question answers. We have quite a few questions coming from our audience. We do appreciate that. So let me start with the politics, and there is a question from Goxel. Thanks for that question. If it says if Senate stays with Republicans but Biden wins presidency, you mentioned a compromise on the fiscal stimulus and the policies. How will that apply to clean energy and electric vehicles, etc.? Also, why, for example, between even same industry market news state different position for companies like Citibank, GS, Bank of America. So that's one question. And staying with that policy, there is also a question from Raghu. Thanks for that question again. And it reads, in the event of a Biden presidency, what fiscal initiatives do you think will meet acceptance by both parties? If you could answer that, then I'll probably club the other questions.
Yeah, well, it will not move very fast. I don't think the Republicans are in the mood to give in too quickly. I would suspect, that the Biden president is probably going to reach out a hand by, immediately accepting that it will be difficult to have any increases in taxes. So the idea of taxing the high income brackets and the corporations to sort of abolish partly the Trump corporate tax cuts, that is out. But I do think that there will be some compromise on the Republican side when it comes to supporting states, to give financial supports to states, locals, states and municipalities, and to reach out in terms of extending the additional unemployment insurance benefits. I think that will be sort of necessary because the Republicans are going to have to reposition themselves over a longer term. They have given the most beautiful handouts to the corporate sector and to the wealthy. All the tax cuts since the 80s, Reagan, Bush Jr., Trump, came from the Republican Party, and what Trump did was sort of fantastic. And what did they get in return? They got in return that the big corporations have been massively supporting the Democrats in this election. So the Republican Party is going to do some soul searching, and Senator Josh Hawley, who is from Missouri, who is perhaps a candidate for a Republican president 4 years from now, already tweeted that we want to become the working class party. So I think that there is going to be some more support for small businesses and working class and unemployment, supporting the households and the small businesses. That is going to be the compromise. I think the package is going to be between 500 billion and 1 trillion. And that is going to be in the limit something. And markets like that, right? No cut, no tax increases, support where it is necessary, but not too much. And for the bigger things, really for the bigger things, sort of infrastructure, new Green Deal, new energy. I think it's going to take some time, really, and I think markets like that, right? We are really in a status quo right now. We are not having much change. That is actually what I take away from these elections.
Great indeed, Luciano. The next question, there are a couple of questions, in fact, on the outlook for the region based on what is happening in the US elections. It comes from Ahmad Sani and Dr. Fallah. Thank you for your question. It's specific to Iran and also generally how the US election result will impact the regional politics and the outlook for the region very broadly.
So I think that Mr. Biden, of course, might want to get back into the Iran deal, and that is something that would, of course, in the limit, put some downward pressure also on the oil. And I'm not sure that will happen very quickly, but I think that some steps in that direction are likely. I suspect that there is very little appetite to significantly change the stance versus Saudi Arabia, for sure not versus the UAE, because these remain the most reliable partners for the United States in this region, and in particular, the UAE has gone out of its way in engaging in this normalization with Israel, and that, of course, puts them in a position in which they are viewed quite favorably by the US right now. So I do think that there will be some attempt to get closer to Iran, but I do not think that will lead to a dramatic change, because it's very important to stress that under the Iran deal, a lot of US sanctions remained in place, and that the Iran deal was really limited to oil, but not to many other economic activities where sanctions remained in place. So this is not going to go very fast. The big change in the region, let's say it came with Obama, not with Trump, when he pulled out 200,000 troops out of the region, and then Trump, of course, has been aging against Iran. That's a bit over. I think that Biden might be actually more aggressive against Turkey. Let's not forget Turkey. Turkey has been actually the most aggressive, or has most aggressively increased pressure in the region over the last years. So I think some stabilization of Turkey, together with the EU and the Arabian allies, in particular the UAE and Saudi Arabia, and gradual sort of unfreezing of tension with Iran without really involving Iran. So I think it's pretty stable. I don't see Biden really rocking or shaking the region, which in and by itself I say it's good news, right?
Great, indeed. Staying with the region and just thinking about the oil again, a comment from Raghu. He says he expects Biden to sort of not touch fracking, if I understood that comment right. But he says by focusing on alternatives, Biden could drive down the U.S. import bill and therefore create some downward pressure on global oil prices. What's your comment on that, Luciano?
Yeah, well, I see a lot of press in the shale sector. No, so there is a lot of downward pressure on production. I see that going forward over the next year or two in the shale sector. So if domestic production comes down, I'm not 100% sure the U.S. can really significantly and quickly reduce its imports, right? But yes, over time, we should not have too many illusions. Over time, the U.S. will push for alternative energy, and it's important to stress that it doesn't necessarily have that much to do with the President of the United States, because a lot of states and local municipalities are engaging in, converting, electricity generation from hydrocarbon to alternative sources, and also are promoting through subsidization and taxation, subsidization of alternatives and taxation of hydrocarbons, promoting increased switching of consumption of consumption of energy from hydrocarbon resources to alternative energy. So there is a long-term trend, but I don't think, I think true, with Trump, there would have been some pushback against the trend. And even Trump doesn't really change that trend, because there is a lot of local governments in the US who promote that trend. But there is a long-term trend away from oil. But the oil imports will remain sustained because of the hit that the fracking industry has had over the last years. At least and, over a year or two, the oil imports will remain sustained. Yeah, sorry.
Great. Thank you. So there are a couple of questions and some anonymous, all trying to understand the investment landscape. I'll probably club them together for you. I'm sorry for this five-dimensional question thrown into you, but this, I think it's best if we address this together. So the questions specific to US high yield, EM high yield, and there are a couple of questions about the Riyadh wants to know the views on Chinese stocks and Europe very broadly, and Hussein wants to know broader investment idea that you have, and anything on the international stocks. Someone believes that Mr. Biden is good for international stocks. I think that we can club all these questions together in terms of what is the trade that you see from the next 12-month point of view, trying to understand the high yield from US and EM, and also international stocks, Chinese and Europe, very broadly, and your views on that.
Okay, so I would say that if Mr. Biden, it's always a bit difficult to answer, but I do think that Mr. Biden will become the president. So let's just assume that. But we also must assume that the Democrats will not control the Senate. Therefore, massive fiscal stimulus is unlikely, and therefore significant US dollar weakness is also unlikely. As a result of that, we must remain very careful with emerging markets. Significant US dollar weakness would have been very good for emerging markets. This is now less likely, right? But as I said, there will be probably less tensions. So also a significant appreciation is not really on the cards. So I would suspect that good quality emerging markets would do well. And these are in particular emerging markets in the Far East and sort of the technology plays, the new economy plays that you have pointed out. And I would add more for structural than for cyclical reasons. So for cyclical reasons, I remain actually, and I think this is important because that gives you a sense of how you must take the long view on these plays. Because I remain actually, for cyclical reasons, quite concerned about emerging markets. For the very simple reason that deglobalization, decoupling is here to stay. The Chinese economic slowdown is here to stay too. So all those commodity plays, such as Brazil and South Africa, that are really more China-centric than I would say some new technology, new economy plays in Asia. They are less China-centric, even if they are geographically closer than the commodity plays right in Brazil and South Africa. So I would say that kind of emerging markets, Russia included, I would remain very, very prudent. And for the very same reasons, I would remain very prudent on high yield bonds. I would remain very prudent on many emerging market bonds. So yes, I would be actually still very cautious. I do think that there are some interesting, so very cautious on emerging markets, except for new economy plays in Asia. As far as Europe, I do think that there are some interesting plays with this. As soon as we have more normalization thanks to a COVID vaccine, and I would say mainly the UK is very well positioned with these big global capitalizations. UK, that's your call, massively undervalued, overly concerned. We are overly concerned with Brexit. The UK has these beautiful large cap multinationals that are exposed to global growth. And with the COVID normalization, I see there some potential. For the same reason, perhaps at some point in time there will be some potential in some German and Swiss cyclical multinationals. We need to look at that too. But I would say right now the UK. So I would say in Europe, the UK, in emerging markets, be very careful. Focus on new economy, Asia, and be very careful also with high yield right now. Because we are not going to have that kind of blue wave, massive fiscal reflation that markets were hoping for only 2 days ago.
Great, Luciano. So there is a last question in interest of time. I think this is, you can probably end this on a positive note. It comes from some anonymous person, and it says, one of the pressing issues, regardless of the presidential election and the race for the White House or the Senate, will be the ongoing spread of COVID-19. Wow, that elephant in the room we missed. And it says, if Biden wins, do you envision a change in approach in combating the virus in the US? And what will be the implications to the economy and the business? And I would probably also add a bit about the vaccine. And we can probably end that on a positive note there.
Yeah. Well, I think I can try to end it with a positive note because I believe in the capacity of human beings to find solutions. But I would also like to end it with a note of humility, right? If there is one thing that we have discovered, really, that we still know very little about this disease, how it spreads, what the best mitigation measures are, what the best repression measures are. So Biden is going to have, of course, an advantage that, he's going to enter the presidency almost when winter is over, right? I mean, you can see it ending by the end. Although in the US the winter lasts longer than on my side of the Atlantic. I remember when I lived in New York, you could still have snowstorms end of March, early April, right? So I think that we will be able to avoid massive lockdowns. And as far as the vaccine is concerned, I think people will find a way around it. So I think we are not going to go anymore through the economic shock that we had between the first and the second quarter of this year. So I think that we are getting gradually out of this. And yes, I must say, but again, I'm saying this with a lot of prudence, but you have close to 10 big multinationals that are working hard on a vaccine, right? And it's probably going to be more like a flu-like vaccine, not something for life that you have to redo every year. And, I am really confident that, this is just the beauty of the human species, our capacity to find a way around it. So I really think that at some point in time after this winter, that maybe by the summer of 2021, we will find a way out of this. But it remains there, and it reinforces our call to focus less on cyclical equities and more on new economy equities, because the new economy is actually profiting because it's offering solutions to restructure our way of life to its clients and to live with this, right? So we need to remain prudent. And we have some cyclical bets in place, in particular the FTSE, your call on UK equities, which are these big multinationals that profit from cyclical pickup. I mean, I would remain moderately constructive about COVID-19, but I must be honest, let's be honest, just like with we will not know the election result for some time, and the COVID, it will take actually even longer before we really understand it.
Great, Luciano. A bit of positivity at the same time being realistic and with a lot of humility. Thank you for that. So with that, I think we've come to the end of today's session. And thank you for all those who've asked your questions. We hope they were answered to the best of our capabilities, and hope you found some value in that. And if you need further help, please do reach out to us through your relationship managers. We would be happy to assist you on with any of the investment strategy phenomena. And from our investment strategy desk, we keep publishing regular reports highlighting investment opportunities. In case you're not receiving them already, please do reach out to your relationship managers, who will then let us know, and we will be more than happy to put you onto our distribution list. So on that note, once again, on behalf of ADCB, I would like to thank you all for your participation, and we wish you all a very nice day ahead. Thank you very much. We appreciate your being with us this morning. Thank you.